So chapter 2 um, brings up some interesting information. This first bit about putting together an investment policy statement, unless you have questions, I'm just going to leave that just from the reading. But there are a couple of things I wanted to point out to you. Three things here on this slide in particular. Hang on just one second. I'm still not quite adjusted like I want to be there. There we go. All right. Okay. Market timing. Market timing is a concept that many people attempt to engage, or is a process that many people attempt to engage in. Basically, market timing, in its simplest form, is picking the times when the market is going to be up, and you want to make sure you're in the market at that point, that you're invested. And then when the market starts going down, that's when you want to have all of your money out into, say, like a treasury. If you were able to do that, you would be a millionaire in no time flat. I've actually, to be honest with you, I've tried a little market timing on my own. Sometimes with the market as a whole by using ETFs, exchange traded funds. So there was a period of time a few years back where the market was what I would call going sideways, which means it wasn't going up or down in particular. It was kind of just bouncing around. And, there'd be 2, 3, 4, 5% bounce back and forth. But it wasn't going up. It wasn't going down. So when you're in a sideways market, the only way to actually make a positive return is to try to time the market. And that worked for a while. I actually, would pick up a couple of percent. I'd set some, buy orders. I'd set some limit orders to buy. And then once I bought in, I'd set limit orders to sell, and I'd get out. Well, that worked for a while the market was sideways, but all of a sudden the market just took off like a rocket. And my limit order to sell had executed, right? And it didn't come back down. So I missed out on something, and yet I was actually incurring taxable income too, because it was short-term gains. So that was I didn't get the lower long-term cap gains rate. So I had a fairly high tax bill on that, and I missed out on the very high upside that once the market took off. The reverse could have happened too. I could have bought when it dropped, and it could have just kept going down. So even personal experience. And I'm telling you, my personal experience is generalizable to virtually everyone, whoever tries to do market timing. So market timing, definitely not a good plan. Now, I'm talking about a few $1,000s that I was playing around with. So I'd do a round lot of a ETF. A round lot, by the way, is 100 shares. So, we're not talking about a lot of money. So, if you want to play around with something like that, see if you've got a model that could actually work, go for it. You'll probably learn the same lesson I learned, though, in that it's fine for a while until it isn't. So I just want to point out, market timing is definitely not something you want to engage in on a regular basis. Then these other two concepts at the bottom of the slide here, asset allocation and security selection. These are two things that we engage in all the time. And these are fairly ordinary transactions or processes that we engage in the process of investing. So asset allocation says, how do I distribute my money across various asset classes? And asset classes meaning you've got stocks, you've got fixed income and bonds, you have currency, you have commodities, and so forth. So those are the very broad classes. You can even subdivide those classes into subcategories as well. So you could have growth stocks and value stocks. You could have large cap, mid cap, small cap, and so on. Likewise with bonds, you could break it down into subcategories. But that's the asset allocation decision. And a lot of that decision has to do with the riskiness of your overall portfolio. You want your portfolio to have a certain level of exposure to these various asset classes. And the amount that you want in each asset class is going to vary depending upon how much risk you as an individual would like to be exposed to. The security selection is another process that everybody engages in. And one way of approaching it is to say, I'm not even going to select securities. I'm just going to buy the whole bunch, which is really what finance theory says. Modern portfolio theory and the capital asset pricing model say we all hold the same portfolio, meaning that we all hold positions in all stocks relative to their market value as a part of the entire market value of all assets. Well, but there are some people who say, nah, well, securities are going to deviate from efficient prices. Some securities are going to be overpriced and other securities are going to be underpriced. So actually, what I want to do is I want to buy those securities that are underpriced, and as they come back up to where they should be, I make even more money than the expected return, than in other words, what I should get for the level of risk that I'm taking on. Conversely, if there are securities that are overpriced, I expect that in the future their price will come back down, and what I want to do is to take a short position in those securities. By the way, if you're not, how many of you are familiar with shorts? Okay, oh good, a fair number of you, but still fair number that aren't. In fact, that's what we're going to spend more time on tonight, is talking about short stock positions, as well as margin long positions. That's the tougher material out of this chapter. But the point is this security selection can become somewhat of an obsession among analysts and investors. And in actuality, security selection is only a relatively small fraction of the return that you're going to get. You should focus on the asset allocation decision, because that is going to have, most research suggests it's about 90% of your return is a function of where you put your money in the broad categories of assets. We know that stocks have very high returns on average. So if you want a portfolio that's going to have a higher return, you want more of your money invested in stocks. Only about 10% of your return is going to be a function of the particular securities that you pick within that broad asset class. So this, by far and away, is the much more important decision, asset allocation. So just wanted to emphasize that. They do talk about it in the chapter, but as I said, this is not opinion. This is solid research. It's been around for decades that suggests that that's the case. The other thing I wanted to point out to you is something that is not in the chapter, but is a really interesting study by Hank Bessenbinder. He's at the Arizona State University, one of the longtime researchers. He did this really neat paper, and he looked back to 1926, and basically the question he was asking is, which stocks would I need to hold if I started in 1926 in order to get the vast majority of the value creation in the marketplace that's occurred since then I think the paper was published 3-4 years ago, so the data probably only runs up to like 2015. And he found out that basically all of the wealth creation took place in 4% of the stocks. You only had to own 4% of the stocks in order for that $1 invested back in 1926 to be worth, hundreds of thousands, if not millions, today. I don't know what the Dow Jones was in 1926. It was pretty low. So you would have that entire gain if you just picked these 4% of stocks. You don't need the other stocks. The other interesting thing is that some of these stocks, some of that 4%, were even in companies like GM. And now you're really starting to doubt this paper, right? Because you're going, well, gee, I thought GM's price was way down. And you'd be right. But GM paid a heck of a lot of dividends over the years. So this paper says you're going to reinvest those dividends as well. And so it's really those dividends that made GM one of the key wealth creation companies out of the all of the stocks traded in the U.S. So also you see some of the usual suspects, obviously, here. But even IBM's price has not been going off the charts lately, but it's because of the dividends that they paid over the years that has made IBM one of those 4% of stocks. It's a pretty stunning number. And I've got links here to a couple of studies. Oh, sorry. Okay. Sorry about that, Adrian. I've got links here. There are actually two schools of thought around this paper. One group of people like the paper because it says, basically to them, it says, you know what? Efficient markets are the only way to go. I hold a broad selection of stocks. In fact, I hold all the stocks because I don't know which 4% are going to be the stocks that do this same thing over the next 100 years. And then there's another contingent that says, oh, we can tell you which 4% those stocks are going to be. We know it. So both these articles, one is one direction, the other is kind of representing the other side. So it's usually the kind of paper you want is, you're getting attention from both sides of this. So you get the stock pickers, the analysts who think that they can pick the stocks that are going to go up a lot more in value than others. And then you get the efficient market folks that think that, oh, no, I can't pick them, so I need to hold all of them. But anyway, I just thought I'd point this out. I'd recommend that you check out these articles. They're not terribly long. This is not the paper. This is an article about the paper. I think I've got a link to the paper that I'll share with you on Canvas, too, if you want to dig through the paper. It gets a little technical, but you could certainly read the intro and the conclusion. One last thing to point out in this section of the material, too, wanted to bring your attention to both a traditional as well as a Roth IRA. This is really more a personal investment tip. And certainly if you don't know the difference, go to the Khan Academy. It's an awesome resource for many of these basic concepts. The Khan Academy has a really good description of each one. Basically, one, you put in the money tax-free and you pay taxes on the way out, and the other, you put in the money after taxes and you pay no taxes on the way out. Well, it turns out the perennial question is, which one should I get? Well, it turns out that Brown, Cederberg, and O'Doherty actually answered that question. And the answer to that question is put about 50-50 in it. 50% in traditional, 50% in a Roth IRA. That's the best strategy. The problem is that you're trying to guess what your tax rate is going to be at retirement. It's virtually impossible to do. So, but if you want more details, again, I've got the link here to the Brown, Cederberg, and Doherty paper. Actually, a couple of these folks are out of University of Arizona, my alma mater, where I did my PhD. So I wanted to point those things out to you. Oops, I still have one more. Also, something not particularly necessarily in the chapter, but I had done a little personal finance talk to some of the students over in the College of Arts and Sciences. And I know that Robinhood is a very popular trading platform for many of you all. And so I wanted to do a little research about what's going on with Robinhood, and I just put it up against E-Trade, not for any reason other than the fact that I have an E-Trade account. And a couple of things popped out to me that I thought were worth paying attention to. So if you look in this column, this is E-Trade, and here we've got Robinhood. Minimum deposit, the same. Stock trade cost, that's your commission, same. Mutual fund trades, ooh, that's where things start to go awry. Robinhood doesn't give you access to mutual funds. Now, that's not to say that you can't get access to mutual funds in other ways. You can go straight to a mutual fund company for no load funds, but it is sometimes convenient to have it there. So that's not a deal breaker. IRA annual fee, 0 in both cases. And then now we get down here, fractional share trading and crypto trading. This is probably the reason that many of you that are into Robinhood may not like E-Trade. But I'm here to tell you, if you're buying fractional shares, I guess the question would be why? It's very easy to buy an exchange-traded fund. If you want exposure to a broad array of shares, you don't need to buy fractional shares. By fractional shares, what I'm talking about is not, 25 or 15 shares. I'm talking about a fraction of one share. Now, yeah, okay, Berkshire Hathaway Class A shares. Yeah, we're going to buy a fraction of that no matter who we are because what's it trading at these days? 380, 400,000 a share? It's up there. I haven't looked recently. It's way up there. But if you really want Berkshire Hathaway, you can buy Class B shares. And they're much more like a regular stock price. I see no reason to buy fractional shares. Unless someone can come up with some reasonable justification, I don't see that as a downside for E-Trade. Crypto trading. Okay. Now this is the tougher one, right? Is crypto trading, is crypto an investment class? My answer would be you can't value crypto. Because crypto, and I'm talking the Bitcoins, right? I'm not talking the coins that get issued with some sort of underlying, that give you an underlying service or product or something of that nature. I'm talking about the true cryptocurrencies. They have nothing behind them. Simply a supply and demand thing. Now, should you have it or not, that's a different question. But do you make a decision on, getting into one particular trading platform because of that or not? I don't think so. At least that would be my answer. Also, no load funds, none on Robinhood, but there are over 6,000 of them listed on E-Trade that you can trade. No load mutual funds, yeah, that's where you want to be. That also negates the need to really buy fractional shares. If you want a particular exposure to a particular sub-industry somewhere, in a particular country even, you can probably find it in a mutual fund. If not a mutual fund, you can find it in an ETF. And then you also don't have access to bonds, fixed income instruments in Robinhood, nor do you get any advisory services. Now, the advisory services are at additional fees and that sort of thing. So you could probably get that elsewhere. But I just thought it was an interesting rundown. And by the way, I also understand a fair number of folks are a little disillusioned with Robinhood since Robinhood cut trading on GameStop back during the short squeeze on GameStop. So anyway, just thought I would share that information with you. And then let's get on to talking about various types of brokerage accounts. A cash account is, did somebody have a question? Joe?
Yes. So is that you subtly saying that you would heed advice to use different platforms?
Yeah, actually, you could do that for sure. Now, the problem is if your investment in GameStop is on Robinhood, it's not as though you could trade it truly on another platform. Now you could short it and negate that position, but that gets really complicated.
No, but I'm saying that it sounds like you're low key suggesting people don't use Robinhood because there's better, E-Trade might provide better platform. Is that what you would say?
Yeah, I would. I mean, I guess I would say that I don't think Robinhood is quite all it's cracked up to be. And I'm not saying, now, the other thing I want to not say is that E-Trade is the one to use. I definitely don't want to say that. But any of the major, TD Ameritrade, any of those other major trading platforms will give you more bang for your buck, unless you're after a particular thing like crypto.
Thank you.
Sure. Yeah, or in my not so subtle way, I guess. And I recognize that I'm a dinosaur when it comes to crypto. I'm not quite the dinosaur that, say, Warren Buffett is. Who Warren Buffett will say, "I don't understand it, so I'm not investing in it." Now, I'm not saying that at all. Now, I think Ethereum actually is where the bang is. Ethereum is a platform for trading, and so I think that's an interesting thing. I think a lot of blockchain technology is really interesting, and could be a pathway towards reducing transaction costs in financial markets even further. Right? I mean, that's one of the key things that we have financial markets for. It's to reduce the cost of transacting. Back in the bad old days, we'd have a central marketplace and everybody would have to come to that central marketplace. But that was still better. That was better than before the central marketplace, where everybody had to move back and forth to each individual person. And then we took that central marketplace and we turned it into an exchange, and then we turned it into a virtual exchange. All of these things have been done to reduce transaction costs. So, yeah, blockchain has some really great potential, I think, to reduce transaction costs. And you think about things like Dutch auctions for IPOs, and we'll talk briefly about that in the chapter on stock markets, or on the stock market, rather, I should say. So a Dutch auction is a way of doing an initial public offering where you don't really need the investment banker. In fact, that's the way Google went public, was with a Dutch auction. That's also the way that, not Mayfair. Was it Mayfair? There's another company I'm trying to remember. It's not coming to me right off the top of my head, but a number of other companies have used Dutch auctions, which basically cut the cost of doing an IPO by millions of dollars. Now, is there a way to do it with a blockchain? Yeah, I think the answer is probably yes. I think we'll see that definitely within your lifetimes, and more than likely within my lifetime. So, don't misunderstand me. I'm not totally against crypto to begin with, other than I don't think you can value it, and I think it's extremely volatile. But I'm definitely not against blockchain technology. I think that's a really useful area. Any other questions, comments? All right. So brokerage accounts cash account is just what it says. You put cash in the account and you use that cash to buy stocks. If you want to get out of that stock, you sell that stock, turn it back into cash, and you buy other stocks. Then we have the next step, and that's usually the first step. When you open up any brokerage account, you're typically limited to a cash account. So, I forget what the limits are, usually 6 months, a year, something like that, before the brokerage house will allow you to open what's called a margin account. And a margin account says, well, you can use your cash, but we'll also lend you money. And so you can buy your stocks with not only your own cash, but you can buy even more shares by using some borrowed money from the broker. Now, obviously, you can also use, I don't recommend this at all, student loans. You could put, that's borrowed money. A mortgage, a second mortgage, you could use that. But when we talk about a margin account, we're talking specifically about borrowed money that comes straight from the broker. Now, the amount that you can borrow from the broker is limited. The Treasury has said ever since 1929, they have set the limit at 50%. You can't borrow more than half the money. It used to be that you could borrow 90% of the money. And when we talk about margin is the net worth in the account. So in other words, your margin prior to the crash of 29, your margin could be as low as 10%. In other words, you put in $1, you borrow $9, and you use that $10 to go out and buy a stock. It doesn't take long at that rate for if stock prices go down and you're long, for you to lose your equity stake, and then you are completely out of it. They sell the stock. If you lose more, then you still owe that money to the brokerage house. And that's one of the reasons that economists believe that the market crashed, was that there was such leverage embedded in these positions. Just took a little bit of a dip in price, and then all of a sudden people's positions started getting liquidated by the broker because they couldn't make their margin calls. And then that drove the price down even further, which triggered more margin calls, which triggered more decline in price, and it became this vicious cycle that caused the crash. So it's been 50% for decades now. And by the way, one last thing, when we have a margin account, we can buy and we can also do what's called short sell the stock, meaning we can sell the stock even though we don't own it originally. And we'll talk more about that in a minute. We're going to start with the long margin position, though, because it's a little easier to understand. Oh, sorry, Matthew, I see your hand up.
Yeah, so when you buy on the margin, is that always going to be callable then?
Yes. Mm-hmm. Yeah, and not only is it going to be callable at the maintenance margin, if it drops below the maintenance margin, but it could even be callable if the broker just says, I want it back. They've got a lot of latitude. Now, they usually don't go to that last one. That second part, they usually don't just call it for any reason. But in particular, in short positions, they can say, hey, we need those shares back. I'm sorry. That's within part of their contractual agreement. But for the most part, you only get a call. You only get a call when you actually drop below the maintenance margin.
So then when you start, like, if say they call it and you don't have the money to repay that, would it be like, would there be interest owed on that too then?
Oh yeah.
What?
Yeah. And they could take you to court over it. Yep. But, like I say, in fact, that's one of the reasons that they don't let people just open up a margin account right off the bat if you're a new investor, a new trader, is that they want you to have a little experience with trading a bit. And then that hopefully instills a little bit of conservatism in terms of don't take too large a position in a single stock. Don't wait till it drops too low before you get out of it. Now, the other thing is with the margin calls where they're set, you're typically going to get a call well before your equity position gets wiped out. It's the last thing the broker wants. They don't want to have negative equity, have you with negative equity, because then they're on the hook, and they're not in that business. So I would say 99% of the time or more, you're going to get a margin call. You'll still have some equity back, but it won't be as much as you put in. All right, so I won't even go over this example of cash accounts. It's too obvious. So let's look at the purchase of a stock with margin. Okay. So here we're going to buy 100 shares of Walgreens Boots Alliance at $80 per share. We have $5,000 and we're going to borrow the rest. In other words, we need $8,000 to open this position up. We put in our $5,000 in our net worth or our equity capital, and we borrow the rest, the remaining $3,000. So our margin, remember, margin is net worth over the value of the stock. So here, when we open the position up, our net worth, the amount that we have in it right now, is $5,000, and the value of the stock position is $8,000. So we have a 62.5% margin. Okay, and I like looking at this in a T account setting. This seems to be the most, at least if you're more of a visual learner, I think this is a fairly easy way to look at it. So when we look at it as a T account, over on the asset side, the 100 shares of WBA. Key thing here, and you'll see that this switches when we talk about the short position. This asset is denominated in shares. We can calculate the dollar value based upon whatever the share price is. So right now, the share price is $80. So 80 times 100 shares gives us a dollar value of 8,000. But that asset value is going to change anytime the share price changes. So that's the part, it's the asset side here that is going to go up or down in value with the share price. Then let's look over here at the liabilities and equities piece of it. Here we have a margin loan. This is in dollars. All right, unless we get a call, that $3,000 is going to be the same no matter what the share price is. Okay? And then to get the equity, remember the old equation, equity is equal to assets minus liabilities. All right? And so we're just going to take the dollar value of the asset, 8,000 minus the 3,000, and that gives us our equity position. And again, we add those two up and our balance sheet balances with $8,000. Okay? Fairly simple. It's going to get a little more complicated in just a minute. So I just give you a little brief overview of where we're headed. We're buying, presumably, if we're taking a long position, we're expecting the price to go up in the future. So we're buying low today. And then tomorrow, hopefully, we're selling high. Now, let's look at a little bit of terminology. We're going to come back to that example in just a minute, but let's get a little more terminology under our belts here. So we've got this thing called the minimum margin. And in a margin purchase, the minimum margin that must be supplied when a position is opened is the initial margin. Okay? So open the position, the initial margin might be 50%. So actually in that example we were just looking at, we could have put in as little as $4,000 to open that position. Now we chose to put in $5,000, which made the initial margin 62.5%. But most stocks, we could put in as little as $4,000, which would have made the initial margin 50%. Okay. The next term that's important is maintenance margin. The maintenance margin is the price at which, is the margin at which you will get a call from your broker, and the broker is going to say to you, "You've dropped below your maintenance margin. I need you to put some more equity into your account. I need you to put some more cash into your account. If you don't put more cash into your account, I'm going to be forced to close out your position." In other words, they will take the stock, they will sell it back to the market at the current price, and they will refund anything that's left over to you after they've paid back their loan and the interest due on that loan. And this maintenance margin, that gets set at very different levels. It gets set based upon the volatility of the stock. So if the stock is very volatile, the maintenance margin will be set higher. So you might see a maintenance margin at 40% maybe, or 35%. So you're putting in 50% to start with, and if your maintenance margin drops below 40% or 35%, you'll get a call. Now, a less volatile stock, you could set the maintenance margin at 30% or 25%. Because here's what the broker is doing. They're looking at how much the stock price moves on a typical day. So how much cushion do they need in order to get you on the phone, give you your margin call, and say, either put in more money or tomorrow I'm liquidating your position. And they want to be able to liquidate it before your equity drops below zero, right? That's their goal. So they're going to set the maintenance margin at a level which they're very comfortable that even 3 days of really bad outcomes, your equity is still going to be positive. And so when we liquidate your position, we can still get our loan back in its entirety plus interest, and then you still get a little bit too. All right, but 2 key terms: initial margin, maintenance margin. All right. Here's Vandelay Industries. Anybody get that reference? You know, the authors of this text are nearly as old as I am, so.
Seinfeld, right?
Yeah, all right. Thank you. Vandelay, yes. George was working for Vandelay, I believe, right? All right, suppose that we've got a share in Vandelay Industries selling for $50. We have $20,000 and we want to buy as much of Vane as we possibly can. So $20,000, and we're assuming here that the initial margin, the minimum margin we can open up the position with, is 50%. And that would be a good assumption. Most of the stocks have an initial margin of 50%. So that means we could buy up to $40,000 worth of Vane, or divide that by $50, and that means that's 800 shares. And again, we've got our balance sheet here. So remember, this is still in shares. It's really important that you remember that in a long margin position, the asset is denominated in shares, not dollars. The dollar value of those shares is going to go up and down with the share price. And then over here, we've got our liability of $20,000. And when we open the position, we have an equity stake of $20,000. Again, the balance sheet balances, and all is good in the world. Now, suppose that after we purchase Vane, it falls in price to $35. That's because they hired George. Your equity loses $15, or you lose $15 per share. And that the entire $15 per share that you lose comes off your equity, right? So in other words, 15 times the 800 shares is a loss of $12,000 off of your 20,000. So all of a sudden, you now only have an equity stake of 8,000. Not only that, but the value of your asset has dropped, of course. And so now your new margin is $8,000 is your net worth, right? Net worth over the value of the stock, 28. So we have a new margin of 28.6%. And let's see, I think we said back here that we had a maintenance margin of 30%. So now we're below the maintenance margin. We are going to get a margin call from our broker today saying you've got to put in more money or I'm going to close out your position. And notice that there's still plenty of equity stake here. If they sold it at 35, you'd get back your $8,000 minus a little bit of interest. And the broker would get their $20,000 loan back too in its entirety. Now here's one little piece of this that might not be so obvious, and let's see. Yeah, no, let's walk through it here. I don't think I have it on another slide. How much do I need to put in if I'm going to keep the position open? Well, what would bring me up to 30%? So if I have 28,000 and I want 0.3, 28,000 times 0.3, so 84 over 28, that would bring me up to 30%. Is that what we're going to do? Is that the broker's just going to ask me for $400? No. because the broker doesn't want to call us tomorrow when the price drops to 34, right? The broker wants to walk away and let this go on for a while. So here's the really bad part for the investor. Once you get the margin call, you've got to bring it all the way back up to the initial margin. Meaning, in this case, since we've got 28,000, that's going to be 14. We need a equity stake of 14,000. We have 8,000 in here already, so we need to add $6,000 in cash to our broker. Our broker is going to deposit that in the account, and that'll bring our equity stake up to 14,000. Now we're good to go for another few days or a few weeks, depending upon the direction of the price, at least until they fire George, which I think they did in the end. Does that make some sense? Okay. All right. So, a key thing, I'm going to say it a third time too. The asset is denominated in shares. You're going to see that when we flip over to the short position, the liability is denominated in shares. And that's why I keep emphasizing this. I think we can skip over this. You can go back through these examples, just more examples of the same thing. Next thing I wanted to show you. Yeah, this is the here. This is what I want to show you. So the next usual question that is when you open up a margin long position, you're going to know what the maintenance margin is, but you're going to need to calculate the price at which you will get the margin call. And you should know that at the time you open up the account so that you know, at what point you're getting close so that you can have the cash available to keep the position open. So here is the way to calculate it. You could start with a formula like this and back into it. So this is really just the margin formula. So margin, remember, it's equal to net worth divided by the value of the stock. Now, what we've done is we've just said, well, the value of the stock here is the number of shares times the optimal price, and we're solving for P. So this is the unknown. And we're going to subtract off the amount that we borrowed. That's our net worth. And then the denominator, the value of the stock, is also number of shares times the price. And notice again the P star there, because that's going to be our unknown. So we know what the maintenance margin is. We know the number of shares, and we know down here, and we know the amount borrowed. So we have just one unknown. Happens to be in two places, but that's just a little algebra problem, not a big deal. So we could actually solve for P by doing that. There is an easier way, though, and that is if we just use the formula that has already been solved for us, and this is going to give us P star. So again, here we're taking the amount borrowed, divide by the number of shares, and divide that divide that amount by 1 minus the maintenance margin. And that too will give you P star. So I leave it up to you as to which method is easier. Personally, I just like to, my memory is so bad that I try to remember as little as possible. If I just need to remember this formula, I can get the answer. I don't need to remember this formula. Now, mind you, also just an FYI for the midterm and the final, I'm going to give you a formula sheet, and it's going to have all the formulas in the textbook. So you won't have to remember it. You can just simply plug and chug. But I think it's also good to recognize that this formula actually you can use it to solve for this P star. But I leave that up to you. So in this particular case, we had a maintenance margin of 40% and 300 shares, borrowed $6,600. So the margin call would come when the price dropped to or below $36.67 in this particular example. Questions about the margin long position? Because this is pretty much all you need to know for that part of it. Now we're going to actually calculate some returns based upon that. One thing to keep in mind when you're calculating a return on any margin position, the money you have invested is your capital. It's not the entire value of the position. It's your capital that matters. So we're looking for a return as we're looking for a profit as a function of your invested capital, not as a function of the entire position. So that's another important thing to keep in mind. So I'm going to let you read through that, and I'm going to skip over to just a brief discussion about hypothecation and street name. Hypothecation is pledging securities to get a loan. You don't have a choice. By the way, when you give the pledge of these securities to your broker to get that margin loan, that hypothecation agreement typically also has embedded in it the right for the broker to use those shares as a part of a short position with another investor, with another client. But the actual hypothecation piece of it is when you buy shares on margin, that you give the right to the broker to basically repossess those shares, even though you don't even have them. The broker's got them, right? But they have a legal right to take those shares and use them to pay off your loan. That's how they can close you out if you don't make your margin call, is this hypothecation agreement. I don't know if any of you are familiar with a mortgage on a house. A mortgage on a house is not actually the loan. The mortgage is a document you give to the bank that says the bank can take your house if you don't pay on the mortgage on the loan. So we use that term mortgage to really we use it incorrectly often to represent the loan. And in fact, it's actually the legal right for the lender to repossess your house. And so hypothecation and mortgage are corollaries. Street name is also important. This is why we have SIPC insurance. So street name is simply that the shares that you buy, and this goes for a cash account too, the shares that you buy, especially in deep discount brokerages, are kept in the name of the brokerage house, not in my name or your name. And the reason for that is that allows the brokerage house to be able to sell those shares like that when you submit an order to sell, because they're already in the brokerage house's name. They've got a second set of books that basically says, yeah, these 100 shares are Bill's, and these 100 shares are Alan's, and these 100 shares are Marcus's. But the actual owner in legal terms is the brokerage house. So then they can easily, if I want to sell 50 of those shares, they can go, sell them. And they don't have to actually, the exchange doesn't even need to know about me. Now, when it comes to getting documents from the company, then they have to manage that so that I get the various documents that the company may want to give out to its shareholders. Voting privileges and things like that. But just to make it easier to trade, we keep most stock is kept in street name. All right, so now we're going into short selling, which is probably a little less understandable. So give it some time. Don't give up on short selling. It's a very important function in the market. It tries to keep a cap on a bull market, really. Tries to keep stocks from getting overvalued. So a short sale or a short position, or I'm shorting something, simply means that I'm borrowing shares from another investor who owns shares. I'm not borrowing them from the company. I'm borrowing from another investor, and I'm writing them a pledge that I will replace those shares in the future with the same exact shares. So I'm going to borrow 100 shares of Apple from my fellow investor. And then with those 100 shares, I'm going to immediately turn around and sell them into the market. That's going to generate cash inflow to me. I'm going to put that cash into an account. And then I'm going to hang on to that position until which time, hopefully, I'm right that the share price drops. And then I go back out into the marketplace with some of that cash, not all of it, because if the price has dropped, I don't need as much cash. I go back, I pay cash for the shares, the same 100 shares of Apple. I hand the shares back to the investor I borrowed from. I may throw in a little interest too. In fact, they do. And then I'm left with more cash than I had to start with because I started with zero, but I sold them at a high price. I bought them back later at a low price, paid a little interest to the person I borrowed the shares from, but I still end up with some cash in my pockets. That's the easy version of a short sale. Now, of course, short sales can go awry because generally the market is trending upwards. And if I happen to be wrong about this, or if I don't have sufficient liquidity to keep the position open and the price goes up and up and up and up and up, then I'm going to be buying them back at a higher price. That's selling low, buying high. Not what I want to do, right? The rule is always buy low, sell high. In the case of a short position, I'm just reversing the order in which I do that. I sell high first, and I'm hoping I can buy low later. All right?
Yeah, that's what happened with GameStop, right?
Yep.
Which is okay. That's what I thought.
Yeah, that's it. Now that's a little different. I mean, it's what we call a short squeeze. So in GameStop's situation, there were a number of hedge funds, and I'm not sure who else, big Wall Street money, that had shorted GameStop. So they had short positions. They had shorted with the expectation that the price would go down. And so they were thinking they were all well and fine. They were going to make a bundle of money until the subreddit on, is it the Robinhood subreddit? I think it was. Got news of... Wall Street Bets. That's right. Thank you, Nicholas. Wall Street Bets subreddit that got news of that and said, "Oh, let's see what we can do with the power of the people." And so basically they said, let's all go out and put $1,000 each into buying GameStop and see what that does. Well, there were thousands. I don't know how many people are on that subreddit, but thousands at least. And that accumulated buying action drove the price up, which caused these big Wall Street firms and hedge funds to get margin calls from their brokers, which caused them to need to go out and buy shares, which drove the price up even higher. So this is known as a short squeeze. The price went up, was it close to 400 even? I think it was over 4 at one point. And it was started off in the 30s or something like that, 20s, some crazy price. So this is exactly what happened. They got now that is different in the sense that somebody else actually took an action to try to squeeze out the short positions. Now the odd thing about GameStop is its price is still relatively high. I haven't looked at it recently, but it's way above where it was before all of this nonsense started. And so I'm not sure their business model doesn't seem to be making a lot of money. So I still think that they're probably significantly overpriced. But I think now the Wall Street money is afraid to put shorts on it because they're thinking, okay, well, the Wall Street Bets subreddit is gonna obliterate us again. And so it's kind of like, the Main Street fighting Wall Street. And actually, in this case, Main Street seems to have won. Now, whether it's Main Street or Wall Street, I wouldn't really want to see this happen a lot because it's creating great fluctuations in price and causing people to wonder about is the market really a good place to put my money? That's for me as a finance researcher. That's what I'm most concerned about. The fact that the small guys won. Hey, all right, awesome. But I don't want either. I don't want the big guys or the small guys to necessarily win if it's manipulating, and it's not in an illegal sense. But if the price appears to the public to be manipulated, then the public's less likely to put money into stocks. And actually, this has happened on quite a few other stocks already. But you were going to say something, Ellen? I'm sorry.
Oh, I was just gonna say, yeah, because I was agreeing with you. Like, doesn't it just make the market look really fragile?
Yeah.
Like it could just do whatever. Like, it's not even predictable at a certain point in people's minds.
Right. Yep. Absolutely. I mean, I'm old enough to remember my grandfather lived through the Great Depression, and he was off the stock market forever. Right. He never put money into the market. So now I'm not trying to make any sort of comparison by any stretch, but we don't want that going on a lot, even if it's Wall Street versus Wall Street, because that would happen too. I mean, if a hedge fund got wind that another hedge fund had a big short position in a stock, yeah. Hey, anybody watching Billions? I mean, I can see what's the character's name? It's been so long; they haven't put out a new series yet. Anyway, Axe, right? I could see Axe making tons of money off of something like that, and I don't think that's right either. So yeah, no, that is a short position for sure. So we borrow those shares from a third party, and we are going to immediately sell them, and hopefully high, and we deposit the cash into the account. The broker keeps the account, of course. And then later on, we're going to hopefully buy back low, and the difference between the prices is the profit that we make off of that position. So, in a perfect world, in an efficient market, what this does is this tends to put a damper on the upward trend of stocks, right? And in particular, you can do this on specific stocks that maybe are overvalued. So the idea here is that we're able to kind of put a damper on that upward run, even if we don't own the stock. So that's a valuable function. And I'll show you, I've got some links here later on in the slide deck that have some data to back that statement up. It's not simply opinion. In fact, back during the financial crisis, the Treasury put a stop on shorting financials. And there's a fair amount of research that looked at that and said, basically, no, we shouldn't have done that. That was one of the few bad things that they did during the financial crisis. All right. So all of this is fairly obvious, right? Long position benefits from a price rise. Short position benefits from a price decrease. And by the way, here's the article. One of the articles. Eckhart Boehmer is a well-known finance researcher, and he's got a piece here in the Harvard Law School Forum about it, and then more details about the financial crisis ban on short selling financial stocks. All right, so here's how the T account works and how we can account for things during a short sale. So we're starting off with 100 shares of AT&T at $30 per share. And again, we're assuming a 50% initial margin. Now, here's the weird part about this. You're actually going to be, all you're borrowing are shares, right? And you're selling them into the market, and that's generating cash. But you're also you've got to put some of your own money up into it, because if the price continues to go up, how is the broker going to buy back those shares? So whereas the asset side on our long margin position was simply the shares of stock, the asset side here is not only the proceeds from the shares of stock, but it's also the money that we as the investor put up. So we've got these 100 shares at $30 a share. We borrow 100 shares, sell them into the marketplace at $30 per share. That generates $3,000 of cash that goes into our account. Our broker also says, oh, well, hey, you've got nothing in this. I need $1,500 from you in order to make sure that we're covered if we have to buy those shares back and you don't have the money. So this other $1,500 here gives you $4,500 in total. All right, so let's look at margin here again. Remember, margin is simply net worth over the value of the stock position. Well, our net worth in this account right now is $1,500. The value of the stock position right now is $3,000. That's 50% margin. Now, over here on the liabilities and equity side, the this should be denominated, and I apologize. This should say 100 shares. Oops, can't write. 100 shares. And currently at $30 per share, that has a dollar value of $3,000. So the actual liability is shares, not dollars. So this piece is what's going to go up and down. The asset in this case stays constant. The only time the asset will change is if we get a margin call and we have to deposit more money into the account. But barring that, that $4,500 is going to be $4,500 no matter what the share price is. It's the liability, the dollar value of the liability that's going to change over time. Remember, in the long margin position, it was the other way around. The dollar value of the liability stayed the same, and it was the asset denominated in shares that went up and down. All right? And then, of course, again, just as with the other one, the equity is equal to assets minus liability. So in this case, we've got $4,500 minus $3,000 gives us our equity position at this moment. Okay?
I have a question.
Sure, go ahead.
I might be jumping the gun a little bit,
Yeah.
but let's say now it drops to 28 per share.
Mhm.
You buy them back at 28. You just made $200 now.
Right.
Now, how much of that $200 would you say is going to the people you borrowed it from, and how much of that would you be pocketing typically?
That depends upon the brokerage house and the agreement that they have, not only with the party that they borrow the shares from, but also with you as the opening the short position. There's an interest, but it's fairly nominal. So I would say, the vast majority of that $200 would be yours to keep.
Okay, cool. Thank you.
Mm-hmm. So here, in fact, here's the example, right? Let's say the price drops to 20 per share. And so we sold at 30. We decide to close out the position. Now, and again, some of the lingo, close out the position, unwind the position, those are synonyms. It means stop doing what we're doing, reverse everything. So we're going to close out at 20. That means we made $10 per share because we sold at 30, we're buying back at 20. And so in this case, we've made $1,000. Now, in terms of, they show it this way, and that's totally fine. But what I like to do is just make a T account here. And I know that this is 100 shares. And I know that equity equals assets minus liabilities. So at $20 per share, that's $2,000. And so that's my liability. And my equity piece is $2,500. So I like to do it as a T account rather than the way they show it here. Either way that makes sense for you is fine with me, just so you get the right numbers. But so you end up with $2,500 coming back to you, minus, like I said, a small, relatively small amount of interest. We're talking, if this was only over a couple of months, just a few percent. at most. Now, on the other hand, if the price goes up to $40, you have just lost $10 per share. So you've lost $1,000. If we decide to close out our position, we end up walking out with only $500 out of the $1,500 that we had initially deposited, minus a little bit for borrowing the shares. Remember, we still pay on the borrowing piece regardless. And again, you could do that as a T account. Just write it out this way: 4,500, 100 shares at $40 per share, 4,000. And so assets minus liabilities leave you with an equity stake of 500. And by the way, if we wanted to calculate our margin on this, again, net worth over the value of the stock position. So we're down at 12.5%. We definitely are going to get a margin call here, right? And we've got to bring it back up to 50%. So let's see how much that is. To bring it back up to 50%, all right, here's the value of the stock, right? It's 4,000. So half of that is 2,000. And we have 500 in it already. So we would need to deposit 1,500. That would bring the value of our asset up to 6,000. That would bring our equity up to 2,000, and we keep going. Or we could just close it out and take our losses. Okay?
That 1,500 we deposited,
Mhm.
what part of the asset column of the T chart would that affect? Would that be like an extra line below the initial margin deposit?
Yeah, I guess as I don't know the debit and credit entries that they would use, but yeah, I would just add, I'd just stick another 1,500 in here. Additional margin deposit. Is that what you mean, Corey?
Yeah, I was just wondering because I know I was thinking about the long term or the long, and it was a little different. So.
Right, absolutely. Well, now I mean, in terms of the long position, we just need to deposit money in order to keep our bring it back up to our initial margin. Yeah, and that will change. That would add 1,500 to the asset side as well. Yeah. Any other questions about long or short positions? You're going to have some exercises to practice on this. I think oftentimes there are these things, and I know when I was learning about options and futures and forwards and swaps, it made sense when I heard it. And then when I tried to go back and actually work through these examples, it got a little tougher. But push on through because ultimately, it's actually doing some examples, working through the problems that are going to really drive home that understanding. So, and you can always come back to the slides here too in the video. Let's see, we're at about 750. Let me see how much further we are in the slide deck here. Yeah, we're almost done. Do you mind? Why don't we just push through and then we can start after break on chapter 3? I don't think we've got all that much to deal with here. So short interest is definitely a metric that we want to look at and understand for each stock. Almost every stock has some short interest. And short interest simply is the number of shares as a percent of all shares outstanding that have been short sold. So it gives you some idea of the negative pressure, the downward pressure on price that some investors have put into the marketplace. It also gives you an indication of how much buying there might be in the future. Let's say price started going up and it started closing out some of these short positions, or people just started closing them out on their own. So those shares need to be replaced. So there are going to be people out buying them. Think of the GameStop short squeeze, right? That's why the price went up so high, is that there was so much short interest in GameStop. And as price went up just a little bit, that triggered some calls, and that caused more shares to be bought, which drove the price up a little bit more, which triggered additional calls, and so on. So you get this kind of upward spiral. And so short interest is a very important metric to look at. Not only does it show the optimism or pessimism in the marketplace about the company itself, but it also shows that, hey, if they're wrong, there's a lot of buying pressure out there to drive the price up even higher. Here's examples of some short interest on Tesla. And another metric that gets used often is this days to cover. So days to cover simply means if all the trades during a given day were devoted to buying back shares that had been borrowed to short, how many days would it take to close out all the short positions? And in this case, that's 3.5 days, almost 4.5 days, 2 1/3 days, and so on. So again, that's another measure. It's quite similar to the short interest, but it also gives you kind of a more realistic sense of what sort of buying pressure there might be out there. Now, obviously, all the shorts aren't going to dominate the market in a single day or in 3.5 days. There's always going to be some other purchases as well. And I think that's about it. I added a bit on the end of the chapter. They talked a bit about REITs. And so I added a little bit of detail about REITs, real estate investment trusts. A really important innovation back in I think they came into being in the 50s, if I remember right, under Eisenhower. And basically, a real estate investment trust is a way of owning real estate where you don't have to buy the entire structure. So I shouldn't say most. I say many real estate investment trusts hold pieces of property with improvements on it. Some of them actually own mortgages, and others have a blend of the two. But let's think about the REIT as just a company that owns pieces of real estate. So you might have a REIT that focuses on strip malls. And they may own strip malls in Cleveland, in Pittsburgh, in Chicago, in LA, in San Francisco. And all of those get put together on their balance sheet. And they've sold off shares in this company to you and I. And those shares represent ownership, fractional ownership of all these strip malls across the country. And then when rent gets paid, that rent flows through the company and straight back to you and I, investors in that company. And this thing is very much a creature of the Internal Revenue Code, because if you meet certain criteria here, then the company itself, the REIT, is not taxed on those earnings. You and I are taxed on the earnings. We have to pay tax, but at least we're not double taxed. So that was just a end of the chapter thing that they talked about, and I added a bit more here. You might want to click on this link right here on the videos on REITs if you're interested in it or would like to learn a bit more about it. And I think that's it for this chapter. So I've got about 7:55. How about if we come back at about 8:05 and we'll pick up on chapter 3. So here we're starting into chapter 3, talking about various types of securities. So, for the most part, I'm going to go through these relatively quickly. When we get to futures and forwards and options, I'll slow down a little bit because those are the creatures that you probably have the least familiarity with. And they're also some of them are somewhat unintuitive as well. But starting at some of the more simpler things, money market instruments and fixed income instruments, what differentiates the two? Basically, what's the length of time to maturity for these? So Money market instruments, we're talking about a year or less. Fixed income securities, we're talking about greater than a year. Obviously, we could have fixed income securities that have only a year left. They'd still be in that fixed income category and would still pay coupons typically. But so money market instruments, we're talking treasury bills, CDs, commercial paper, things of that nature. They typically are sold at a discount, on a discount basis. And what that means is that they have a face value, and let's say that face value is $10,000, which is a typical T-bill. And instead of paying coupons on that, because they're such short-lived instruments, they're less than a year, we simply sell them at a price below $10,000. Now, normal times, that might have been that we bought it at $9,500, and at maturity, it paid $10,000 or its face value. Today, we'd be lucky if we found something at $9,985 or $90. Their interest rates are so low. The discount we get is so tiny. But nevertheless, it's still a discount instrument. So our interest is the difference between what we paid and the face value of the instrument. It just makes it simpler to manage. You don't have to keep track of who are we sending the coupon to and so forth. One other thing, just for a personal finance piece of it, down here I've got a link to the Treasury Direct site. So if you wanted to buy any sort of treasuries, you don't have to go through a broker. You don't have to do anything on E-Trade or Robinhood or anybody. You can go straight to the U.S. Treasury and buy them through this site. It's treasurydirect.gov. I won't go into the details of that. I'll leave that to you to delve into it. But you get the, I think it's the average of the bids that were made by the money center banks on a particular issue. So you get a really excellent price on it as well. So just an FYI for your personal finance type of things. All right, then we go into fixed income securities. Those are securities that have a life greater than a year. And again, we've got treasuries, we've got notes and bonds, notes being shorter life and bonds being longer term. And then we've got corporate bonds, which add a default risk to the picture, as well as interest rate risk. And then things like other types of fixed income instruments, car loans, student loans. There are a bunch of other types that you can get a hold of too that collateralize mortgage obligations, things of that nature that get into more exotic instruments. But these typically pay coupons. So you'll get either a quarterly, semi-annual, annual coupon payment. There is interest rate risk in these instruments. And that means that as interest rates go up and down, if you choose to sell the instrument, you will have to change the price in order to sell it into the marketplace and still deliver the expected yield that the market is now demanding. So if rates go up, the price of your security drops. If rates go down, the price of your security goes up. So there's an inverse relation between those. And we're going to talk a lot more about that when we get to, I think it's chapter 10, if I remember right. Oh, one last thing. The bond market, for some reason, well, actually, it's not for some reason, it's fairly clear, is fairly illiquid. There's not nearly as much trading that goes on in the stock market. So when you go in to buy and sell these things, there might not have been another trade in the entire day, or several days, depending on the bond. And part of it is that each company, Apple has dozens of bond issues out there. So when you buy Apple stock, it's one stock. But when you buy a bond from Apple, there could be this bond, that bond, multiple different bonds with many different maturity rate dates and so forth. We can talk about this briefly. This is just an example of a quote sheet from Morningstar, and this is for 3M. They have a symbol that represents each individual bond, what type it is it callable? bonds can be callable. So what a callable bond is when a corporation issues a bond at a particular interest rate, that interest rate gets paid through the life of the bond. Now, if interest rates happen to drop, if you own a house, what do? You go out and refi the house, right? You get a new mortgage. You pay off the old mortgage. Well, a callable bond is like refining the corporate debt. You have the ability to call the bond back in. Now, this has to be done up front. Virtually every mortgage, it used to be that some mortgages were not payable in full, that you would have to pay a fairly severe penalty. Today, that's been erased. You no longer face that. But not all bonds are callable. Only if a priori you set that up. And usually there's a window during which you cannot call. There's a non-callable window right after the bond is issued. Sometimes that's 3 years, 4 years, 5 years. And then after that window, then the bond becomes callable. And even then, you have to call it at a premium usually. So if the face value of the bond is $1,000, which is the typical face value of a corporate bond, the call premium might be an extra $100. So if the company wants to call that bond back in, they don't just pay face value, they pay face plus the premium. And again, we'll talk in greater detail about that in Chapter 10. Here's the coupon rate. So this would be, 3.875% on the bond's face value, and this is semi-annual. And again, that's typical of the bond that it's semi-annual. And then here are the prices. And you'll notice that these prices are below, this is as a percent of face, all right? And so 96%, 91%, 86%, 99%. What that's telling us is that these bonds are selling below their face value, which means that the interest rate in the market today, at the time this quote was copied, must be higher than the coupon that those bonds are paying. So that's what drives that price. And then they also give you a yield. Typically, that is a yield to maturity, which is the what you expect a priori to get when you invest in that bond. Now, that is different from the actual realized yield. And again, we'll talk a little bit more in more detail about that in the bond chapter, in the fixed income chapter. In fact, we could actually have an entire class. We could have multiple classes on fixed incomes. They're fairly complex, but we're going to get into some of the more important subject matter, things like duration and duration matching and immunization in that chapter. Bonds are also rated. These are the three primary rating agencies: Moody's, S&P, and Fitch. And here is their categories. They each have their own set of categories. This red line below that category, so BA1 and double B plus and double B plus for Fitch, those delve into the junk bond category, or what's also known as non-investment grade. Oops, I can't write. So the non-investment grade, there are a number of fiduciaries, financial institutions, that are disallowed from investing in non-investment grade bonds. You and I can do that all day long. But what differentiates these from the bonds up above that line is that they're much higher risk of default. So the companies that issue these are much closer to not being able to pay back not only the interest, but the principal too. And that's a real serious problem. So, and of course, up here are the kind of the gold standard, the AAAs, and the in all three categories. And then that's when they start changing. So we got a AA1 or a triple or a double A plus in the other two. The other thing to know about Moody's, S&P, and Fitch, who do you think pays for these bond ratings?
companies whose bonds they are?
You got it. That's it, Joe. The company who issued the bonds are paying for the ratings. Is there a problem? Yeah, there's a problem with that. Exactly. In fact, it's fairly common knowledge that companies will shop around. So I might have my bond issue rated by Moody's, but not S&P and Fitch. Guess why? Moody's gave me the highest rating. So why do I need S&P and Fitch? I get a lower yield. I get to pay less interest if I have a higher rating, less default risk. So there's a real serious problem here, and this came to light quite bluntly during the financial crisis. Is that a lot of these securitized products were literally shopping around, and the bond rating agencies, they were downgrading them after after the investment had failed. Oh yeah, hey, it's not AAA anymore. It's like B2. Sorry, that's a little late. My money is gone. While this is right, it's difficult to come up with a better model. Maybe we have bond rating agencies that receive some sort of general payment from all companies and they guarantee some sort of rating. But right now there's a very serious bias, and oftentimes we see that the ratings follow the change in the company rather than precede it. There's quite a bit of research still going on to confirm that. I wouldn't want to say that it's rock solid evidence, but I would say that there's some serious concerns about the system, particularly when we get into these stress situations. Then we can move on to common stocks and preferred stocks, and we're going to focus predominantly on common stocks in the class, but preferred stocks are interesting. They're a hybrid instrument, right? So a preferred stock has features similar to common stock, but it also has some features that are more similar to a bond. It has a dividend that is fixed, but unlike a bond, which is like a coupon on a bond, but unlike a coupon on the bond, most preferred stocks, you can forego that dividend. Company doesn't have to pay it if it doesn't have the money. So that makes them a little riskier than bonds, but it also gives the company a lot more flexibility. It's also a way that's often used by other corporations to have an ownership stake in another corporation. There's a preferential tax treatment on these guys, so that's another reason for preferred stocks. You all know what common stocks are. I'm not going to bore you with that. Dual class stocks, though, maybe you're not familiar with that. Dual class stocks have multiple classes of stock. So I was talking a little earlier about Berkshire Hathaway, right? So there's a Class A and a Class B stock in BRK. So BRK-A, BRK-B. And they have different voting rights. You can convert shares of Class A into B, but you cannot go back from B to A. And when you do convert from A to B, your voting right gets diluted. You lose voting power. You gain in having a more liquid market that those of us who don't have $300,000 or $400,000 to put into a single share of stock, you gain that marketplace. You gain some liquidity possibly, but you do lose voting shares. Now, this is, especially with the tech companies, this has come under some pretty serious scrutiny. So, the Mark Zuckerbergs of the world, and they've held these classes of shares that allow them to maintain majority control of the company without maintaining majority share ownership. So it allows them to diversify a little bit, but still have majority control of the company. So there's been quite a bit of debate about the efficacy of this, the fairness of this, and whether whether this should continue. And there have been some changes in that, especially in the newer companies doing IPOs. Yeah, just gives you an example of the various voting rights on the classes that the founders are going to hang on to. So, yeah, Groupon is really seriously in control of that company. And here's a link with a bit of a article about the Berkshire different classes. You can feel free to click on that as you're browsing the slides. Just some quotes, nothing terribly interesting there, other than, volume is an important metric to look at, as is change, and particularly percent change. And same animal, just more of the. As far as high dividend yield stocks, those have been fairly popular, especially in light of nearly zero interest rates on treasuries and other securities. Even corporates have been very, very low. So one way to get a regular payment, a quarterly payment, is to buy some blue chip stocks that happen to pay a fairly high dividend. So that's been a strategy that a lot of people use, is to buy these high dividend yield stocks. Has anybody heard of the strategy called Dogs of the Dow? No? Used to be a lot more popular. I think it's lost some of its luster simply because it doesn't work as well anymore. Markets actually are efficient. So the way the Dogs of the Dow worked was that, that there are 30 stocks in the Dow, right? The Dow Industrial 30. So of those 30 stocks, we're talking about really, really big companies, the biggest companies in the U.S. and in the globe for the most part. So, and most of those companies pay dividends. And those dividends are extraordinarily stable. They've paid dividends for decades, and they're going to continue paying dividends. And they don't very often raise them. And if they do raise them, it's only on a very orderly fashion. And that's something, again, we're going to talk a bit more about when we talk about valuation of stocks. But the reason that that's important here in this context of the Dogs of the Dow is that what we can do is we can calculate a dividend yield. So it's the annual dividend divided by share price. So it's the annual dividend per share divided by share price. That's dividend yield. And when we see that very high, when we see a very high dividend yield like 5%, or it's not uncommon to even find some that are double-digit yields, 10%, 11%, 12%. The thing that doesn't change is this numerator, right? Because dividends are very constant. If companies cut their dividends, the market just pummels them. I mean, their prices drop like they're coming off of a cliff. So companies don't cut dividends, and as a result, they don't want to raise them too fast either, because that means that maybe in the future I'm going to have to cut them. So the dividend stream is extraordinarily stable. So when dividend yields change, it's as a result of the share price changing. So as share price goes down, dividend yield goes up. All right? So the way the Dogs of the Dow strategy worked, and I haven't read up in the last couple of years, but it has still been working a little bit, but it's more spotty, is that out of the 30 stocks, you'd calculate the dividend yield for all 30. You'd rank order from highest yield to lowest, and you'd pick the top 10, and you would buy those stocks. You would hold them for the entire year. You'd obviously collect the dividend too. And then you would reorder the stocks a year later. You would calculate the new dividend yield and rank them from high to low. And the stocks, if the stocks that you had already in your portfolio were still in the top 10, you held on to them. Some of them, though, their share price has gone up, meaning that their dividend yield has gone down. So they're dropping out of the top 10. So you're selling stocks whose price has gone up. And then you replace them with stocks whose price has gone down because those stocks now have the higher dividend yield. And you just repeat. It was a strategy that actually yielded, I think in its peak, it was getting over a 1% additional gain over just the Dow 30 itself, which is pretty phenomenal. If you can get 1% better, and you're still buying these really blue chip, really strong companies. So that was an interesting strategy that used this high dividend yield as a metric to pick a portfolio. And basically, you were forced to sell the stocks that went up, and you were forced to buy the stocks that went down. There was no psychology, no behavioral finance piece to it at all. So pretty interesting strategy. In fact, there are a lot of trusts set up already that way. I'm sure you can, if you Google Dogs of the Dow Trust, you'll find a variety of them out there. Before you actually buy anything like that, though, do please look at the current research, because it's been a while, a couple of years at least, since I've looked at it. And I think the ability for the Dogs of the Dow portfolio to beat the Dow 30 has declined over years. And that's actually an okay thing, because that means that markets are more efficient now. Matthew, you had a question?
Yeah, how would like the buying and selling of treasury stock and or just selling new shares to increase the volume of shares in the market, would that also affect this strategy, because it would either increase or decrease?
Yes, absolutely. In fact, you're asking a question near and dear to my heart, because some of my research deals exactly with that sort of thing. And this is what we would call a seasoned equity offering. So you've already got shares out there trading, and if you issue more shares, you would sell them at a particular price. You might sell them at a discount to the current market price. And that would increase the number of shares outstanding. That would also, though, increase the dividend that the company has to pay, because you're going to pay the same dividend. Once they're out there, they're all the same shares. We can't differentiate between the new shares and the old shares. So the real impact would be, what does that issue do to the share price of the company? And here's the really weird piece of this. If you're doing a seasoned equity offering, on average, the announcement return for that sort of share issuance is negative. The stock price goes down. We in the finance research profession have been trying to answer the question why for decades now. One of the better answers we have come up with is that there's this pecking order to raising capital. And if I have the choice to raise capital internally by, generating more profit and keeping it inside the company and then using that to grow the company with new investments, that's choice one. Choice two is if I can issue some debt, because when I issue debt, I'm paying a fixed amount to those bondholders. And if I can generate more than that fixed amount, all that extra more goes to my shareholders. So that's the second way that I would raise funds to do a new project. And those two actually, we can't check on the internally generated funds, but we have looked at bond issues, and it does appear that share prices go up when new bonds are issued. And that's also a little difficult to disentangle, because that also means more debt and more leverage and so on, but put that to the side for the minute. But when we issue stock, that's the third method to raise capital. And what it basically, at least theoretically, what we think it's doing is it's a signal to the marketplace that we don't think this new project is all that great. And so we're not going to use our own money to do it. But if you want to pay some money to buy this new stock, we'll take your money. And the existing stockholders will still be a little bit better off. So that's kind of the thinking. We still don't know for sure. The data is too difficult to really get a direct read on it. But on average, prices drop when they do a seasoned equity offering. And it's a fairly substantial drop. We're talking like 3% abnormal return decline in a day. So yeah, it's an interesting area. There's also, you mentioned treasury stock, and that's also an area that I've done a fair amount of research in. In fact, there's treasury stock, and there's also this thing called authorized shares. And authorized shares are, authorized shares are stated in the corporate charter. The amount, right? So I might have 100 million shares authorized. And of those 100 million shares, I've issued 10 million. Now, some of these authorized shares might be held in the form of treasury. Those are shares that I've repurchased. I have yet to find an accountant who can tell me why we have treasury stock and how that's different from never issued authorized shares. In my view, as a finance person, there's no difference. That's a little nuance. But so these authorized shares versus the number of shares actually outstanding. What this means is that I have the ability to issue 90 million more shares before I have to go back to my shareholders and ask them to increase the authorized shares. The only way I can increase this amount right here is to go back to the shareholders and say, I want to change the corporate charter. And that usually requires a supermajority and a special meeting of the shareholders. Very costly, very slow process. Now, it happens, but companies don't like to do that. So here, management actually could do a number of things. They could do a seasoned equity offering, an SEO. They could do a stock split. Or they could do a stock dividend with these extra shares. So in other words, if I were to do let's say I did a 2-for-1 stock split. So that means for every share you own, you turn it in and I give you back 2 new shares. So what that would do is out of these 90 million, it would take 10 million shares away. That would leave me with 80 million authorized but not issued. And that would change my issued amount to 20 million. And I won't go into I won't bore you with the details, but it's really interesting. What we find is that we look at a group of stocks that do stock splits, and when they have a very high level of authorized but not issued shares, the positive return to the stock split announcement is double that of the typical stock split announcement. And our thinking is that what that actually is indicating is that the management team is giving back some power to the shareholders. So we've got a tension between shareholders and management. Who has more power? And when management does a stock split, they're using up some of these authorized but unissued shares. That takes power away from them to do other things like SEOs or stock dividends or mergers. They can use these shares to buy companies. And it gives back to the shareholders. So anyway, sorry to go so far off the path, but it is an interesting thing to think about. Thanks for the question, Matthew. I know you didn't expect quite so long-winded an answer, but all right. So let's get into defining a couple of terms here. We've got real assets, financial assets, tangible, intangible. So real assets are just what they really say. I mean, we're talking real estate, we're talking property, we're talking commodities, gold, titanium, oil. We're talking structures, infrastructure. They have an intrinsic value in and of themselves. They don't need anything else. I mean, a piece of real estate, what are you going to do with it? I can do all kinds of things with it. I could graze cattle. I could build a house on it. I could drill for oil, variety of things. So there's this intrinsic value that these real assets have. Real assets are great, and that's really what underlies the value of everything else. But the trouble with real assets is that it's difficult to break them up into pieces. You know, just like I was talking at the back of chapter 2 about real estate investment trusts. You know, you want to buy a big apartment building, and you could do it as a partnership, but that gets pretty messy, legally speaking. And especially if you want to get out of it, it's really messy. You've got to dissolve the partnership, reconstitute it with less partners, or have a partner buy out another person, somebody buy out one of the partners. So that's not a good way to hold that ownership. But if we had a way of structuring it such that we just had a company that owned it, and then we had shares of that company that were held by individuals, we could break that up into many thousands of pieces. And so now if I wanted exposure to the apartment market, I could buy that exposure for just, $50 a share. So that's the problem with real assets. In comes finance. And we have these financial assets. This is really the value. One of the key things that the finance market brings to the economy and brings it to our society is the ability to divide up these otherwise lumpy real assets into bite-sized pieces. That's why finance has grown so well over the past half a century. So here we've got these financial assets, stocks, bonds, currency, mutual funds, derivatives. All of these things are based upon real assets, but they allow us to have ownership in those real assets, and not like that apartment building. Who am I going to have manage it? Hey, I could have the corporation do it. I don't have to have ownership and management in the same party. I can separate those things. So this also has to do with the innovation back in the 18th century of the corporation, or the 19th century, I think. So the corporation, the legal form called a corporation, has been very helpful too. But this is really what gives finance the biggest fraction of the economy that we have. The financial market and finance in general takes up 15, 16, 17% of the economy. And the reason it does is that it allows us to break up these real assets into smaller pieces, and we have this contractual ownership. Oh, sorry, I clicked on the link here. The photo that you see there is a Fearless Girl. Has anybody read about Fearless Girl? Click on this link and look at the Wikipedia page. She's standing facing off the New York Stock Exchange. Originally, the artist had juxtaposed her facing off the bull of Wall Street, right? So there's this huge bronze bull that sits a little bit off from the New York Stock Exchange on a side street. And that's been around for ages. Well, this artist, and I don't know what the date was recently, in 2017, installed Fearless Girl, which is this, a very small statue, maybe 3.5 feet high, facing off the bull of Wall Street, which was pretty awesome. The artist of the bull actually complained. He said, you changed the context of my work. It has a different meaning and you can't do that. So actually, the New York Stock Exchange said, hey, that's all right with us. We'll buy Fearless Girl. She can face off the exchange. Anyway, just a interesting sidelight of that. And so there she is facing off the exchange. This was during one of the trips that we do, student trips with the John Carroll Finance Club. I think it was in 2019. We went to Wall Street. Then there are these intangible assets, assets that we can't really touch. They're contractual. They're a fiction of the legal system. So literally knowledge, and I think of that as one of the things that never shows up on the balance sheet are the employees. And the employees of a company can have a great value generating process. I mean, think about the employees of Apple. They've invented these new product categories that never even existed. So employees are an intangible asset. They're not counted on the balance sheet anywhere. But then we have more tangible, intangible assets, if you will. Patents, trademarks. Those are legal contracts that allow a company to monopolize a particular process or pattern or design or something of that nature for a period of time. And then we also even have goodwill. Goodwill only shows up on a company's balance sheet if it's purchased another corporation for more than its book value. But all of these are considered intangible. And then we have derivative assets, which is what we're going to be talking about for the rest of the class period. It'll probably drag over into Tuesday as well. Derivative assets, not unlike financial assets, which don't have any value in and of themselves. They are really contracts. And when we think about a corporation, I can't tell you who this quote is from, but we can think of a corporation as simply the nexus of contracts. Meaning that really, what is a corporation? It's all has to do with the legal relationship between a variety of parties, right? We have shareholders, we have management, we have customers, we have suppliers. All of those relationships are bound together by contracts. So really, what is a corporation? It's the nexus of contracts. And these derivatives are also contracts. Nothing more, nothing less. And what these contracts do is they use what's called an underlying, and that could be a stock, that could be the value of a commodity, a barrel of oil, a bushel of corn, anything that you can think of, either a real asset or a financial asset. And basically this underlying, we look at the price of that thing, and based upon the type of contract that we have, we can derive what the value of the forward futures or options is, based upon the value of the underlying asset. So derivatives are a contract between two parties, a buyer and a seller, whose value is determined by yet a third thing, this underlying asset. And it could be a financial asset or a real asset. And they make the market more liquid. They allow us to input more leverage into our investment positions as well. And they do what is called completing the market. So let me jump over here to the blackboard. And so this completing the market is a really important concept in finance. Let's say that we only have 2 time periods. This is easily expandable to a multiple time period, but the easiest way to understand it is to think about beginning of time, end of time. So we're standing here at the beginning of time, and we have three possible outcomes at the end of time, at time one. And this is boom, normal, and bust. So different states of the economy, three different states of the economy. And what I'd like to be able to do is to invest in various possible outcomes. And let's say that each of these is equally likely. We don't know which one is going to occur, but we all are in agreement that there's 33 and a third % chance of each one occurring. Now, I've got a couple of instruments. I've got an instrument that I can buy here called Security A. And when I buy Security A, it pays off $1 if there's a boom and 0 otherwise. I've got Security B, and it pays off $1 in the normal state of the economy if that occurs, and 0 otherwise. And then I have a risk-free security. And that pays off $1 in every state. And one other constraint, no short selling is allowed. So here I have 3 different securities, 2 risky securities and 1 risk-free security. And I can invest in A, and if boom occurs, I get $1. I invest in B. If B occurs, or if it's a normal economy, then I get $1. And I can invest in the risk-free, and I get $1 no matter which state occurs. The only problem here is that while I could buy that risk-free, I can't get a risky position in the bad outcome, in the bust economy, because I only have these 3 securities. I would need a third security, C, that pays $1 if the economy goes down the tubes, and 0 otherwise. But I don't have that security. This is an incomplete market. If I were to add this security C to this list, I would complete the market. In other words, I would be able to have an outcome in all possible states. Now, I know, in the abstract, you think, well, who cares? I mean, I can get a risk-free. Well, that's true. But I really, to have all possible outcomes covered, I really want that risky investment too. I want to be able to take that risky investment if the economy goes down the tubes. And so it's a very important concept. Here's the punchline. What forwards and futures and options do is they complete the market that we live in with stocks and bonds and commodities and currencies and everything else. You still can't quite get the payoffs that you might want to get. And so options and forwards and futures and swaps and all the other types of derivatives that are out there actually provide this opportunity to make a more complete market, which brings value not only to the market, but to society as a whole. This is the good part of derivatives. Now, derivatives really get a bad name in the press because derivatives are very powerful animals. And if in the wrong hands and used improperly and sometimes even illegally, they can create a lot of damage. AIG created a heck of a lot of damage and cost billions. But I think as a finance researcher and a student of the economy and finance in general and even of society, I think there's still value above and beyond what we lose when they're misused. Now, again, that part of it is truly just an opinion. But anyway, this is what a complete market looks like, and hopefully that makes a little bit of sense to you, that these derivatives actually help us get closer to that complete market. So let's, we've got a little bit of time left here. Let me try to jump into the futures and options piece and give you a little bit of a understanding of those animals. Futures contracts are relatively simpler, I would say, than options. And futures and forwards, you can think of those as kind of twins. Options are a little different animal. So many things that I say about futures can also be said about forwards. The key differences are that futures are only on a limited number of securities and underlyings. They have very specific times and dates on which they trade, and they're traded on exchanges. A forward is a customized futures contract. And you can have a forward contract on something that there are no futures on, and it can be in very large amounts, and they can have any sort of maturity date that you want. Futures are more the reason they're standardized is that makes them exchange tradable, and that lowers the cost considerably. So you can have futures contracts on indexes, on fixed income, on foreign currencies. You can have it on commodities like wheat, crude, cattle, gold, silver, whatever you want. There are even weather derivatives, right? So here's the way a futures contract works. It's an agreement, and again, don't forget, all of these things are simply contracts between two parties, a buyer and a seller. So the buyer of the contract, of a futures contract, says, hey, I'm willing to buy a barrel of oil from you, but I don't want it today. I want it in 6 months. And I'm willing to pay you X dollars, knowing that the current price of oil is X minus 10. And the seller of the contract says, okay, I'll take X dollars for it. In 6 months, I'll deliver 1 barrel of oil to you for X dollars. We write that contract. 6 months go by. The buyer presents the contract to the seller and X dollars, and the seller presents the oil. Done. The other way to think about futures contracts, and this is not as good an example as it used to be, but I guess during wasn't there a recent period of time when layaways were more popular? So it used to be if you wanted to buy a suit or a dress or something that was a little more expensive than you're used to buying, and you didn't quite have the money to buy it all at once, instead of using a credit card, you could go into your local department store and find that item and put it on layaway. So layaway was simply a futures contract. So you walk into the store, you try on the piece of the garment, and you say, oh, I like this suit. It fits perfectly. I don't have the $500 or $600 or $1,000 to buy it right now, but let me give you $300 right now. I'll come back next month and give you the other $200, and will you be okay with that? The store would say, yeah, sure, we'll put it on a hook back here and save it for you for a month. And a month later, you come in, you pay the other $200, you pick up the suit, and you go, that's a futures contract. Same thing. So really, a futures contract actually, on the delivery date, becomes what we call the spot. The spot is if I were to buy a barrel of oil today. I know what the price is. I can just look it up on the internet, right? But the futures contract for 6-month delivery, it's called a futures contract. Now, once I get 1 day away from that delivery date, all of a sudden, it's the spot contract because it should be priced the same. It's 1 day from being delivered to me. So really, in many regards, the only difference between a futures contract and a immediate purchase of the item is that we're waiting some period of time. And that also means that the price is going to be a little different. And determining that price is the tricky part of this. So here's a quote on soybean futures from the Chicago Mercantile Group. And that's one of the key markets for futures and options contracts is the Merc in Chicago. So here we have a delivery month. And this one is a little bit dated. Here we go. January 8th, 2019. So there was a contract that delivered after the 8th, sometime still in the month of January. There's another contract that delivers in March, so 2 months later. There's another contract delivering in May, July, August, and September. And there may even be other contracts further out into the future. So each of these are separate contracts. And then we have prices for each of these things. So 905 hyphen 4 or apostrophe 4. That means, well, we'd have to look it up. In fact, we would have to go up here to this tab. This is just an image, so I can't click it. But if we were on the CME group, we could actually click on that and see what the contract spec said. What's this mean? Well, I'll tell you what it actually means. It's this is measured in cents per bushel. And this last bit right here, after the apostrophe, that is eighths of a cent. So in other words, this would be 905 cents or $9.05, and 1/2 of a penny. So that would be 5. So $9, 5.5 cents for that bushel of soybeans. And that's for delivery later in this month. And then a couple of other features here. You've got the volume. That's the number of contracts that traded. We could also, when we're in the contract specs, we can see, I forget whether I've got the specs in. I don't have the specs in this. I'll show you that later on, possibly on Tuesday. But it also tells us how many bushels we're buying in this contract. It might be 5,000 bushels. A bigger contract would be 10,000 or 20,000 bushels. And the interesting thing about these futures is that the CME, this is like, you go into the grocery store and you see an entire aisle of cereals, right? And you find the cereal that you particularly like. Well, the CME is doing the same thing. They've got these various contracts on soybeans, on corn, on wheat, on oil, on hog bellies, whatever you want. And they're continuing to put different contracts up on the shelf to see if anybody wants to buy them. And if nobody buys them, they take them back down off the shelf and they put a new one up. So now there are obviously some contracts that have huge volumes on them. Look, this contract just today or that day, over 2,000 contracts traded hands. Here, 57,000 contracts traded hands, 20,000 contracts traded hands. So this is a very popular product. But they'll try maybe a smaller contract, maybe a bigger one, just to find that sweet spot in the market. Because this is effectively the CME Group's products. They own it, they run the exchange, and it's all done online. So that's futures in a nutshell. Let me just touch on options, give you kind of the very basic intro, and we'll have to pick that up and finish it up on Tuesday. And so let's see, it's 9:02.
Can I ask a quick question about futures?
Oh, yeah, sure. Go ahead, Joe.
So would you say that different products based off of, what industry, the futures on them are very varying, I guess? I mean, I feel like oil would be tough in, more volatile markets. But what about something like coffee beans?
Mm-hmm.
Or, where it's a less volatile market? Would you say that futures change based off of which market space you're in greatly, or that it's...
Do you mean the price of the futures contracts or the actual type of contracts that are available?
Well, price. I mean, in a
Uh-huh.
highly competitive space, I feel like the price would change a lot based off of who's willing to pay for it.
Yes. Well, and here's how. Um, so let's say that this is the price of coffee beans in the spot market, right there.
Okay.
And then let's say that this is May of 20. Let's make it 2022, and we're back here in July of 2021. Yeah, I've got a crystal ball. But so let's say that so this is the spot price of coffee. Let's say we have a futures contract on coffee. And let's see, that futures contract, the price is going to be starting a little bit above the price of the spot contract. And the reason that I say a little bit above is that the way we can determine the price of a futures contract is to think about, well, what would I need to do to create a position in coffee out here in May of 2022 without futures? Well, I could borrow a bunch of money. I could go out and I could buy a bunch of coffee beans and I could store them somewhere. Now, remember, I haven't paid anything out of pocket yet. So it's very much like a futures contract, because a futures contract you don't pay for until you take delivery. So I borrowed money. I bought the coffee beans. I've stored them somewhere. I let the time elapse, and I get over here to May of 2022, and I say, okay, now I'm going to pay off the loan plus interest, and I'm going to pay the storage fee for the coffee beans, and now I get the coffee beans. So that's created, in essence, a futures position in coffee. However, it took, dealing with the physical world. I actually had to find the coffee, buy it, find a place to store it. Maybe I even had some spoilage, things of that nature. So typically, the futures price is at a value above the spot price of coffee currently. And that difference is part of the what's called the cost of carry. And that directly relates to exactly the process I just described to you, because I could actually create that position not using futures, but using the real world. The problem is that the real world gets expensive, and I've got to have storage, and I've got interest. Futures are so much easier. But that also helps me to price that futures contract, because I know I can create the same thing, the same payoffs with the real world. So what that's going to do is that's going to keep that futures price very close to the spot price of coffee. And what's going to happen is it's going to approach, as we get closer to delivery, it's going to equal the spot price of coffee on the day of delivery. Because at that point, that futures contract becomes spot price of coffee. They're one and the same, because we're delivering tomorrow. If I were to buy coffee spot, I'd deliver it tomorrow as well. So the price moves very close in tandem. It's like a very, very tight spring, and that spring keeps contracting. In fact, if we were to plot this just as the difference between the spot price and the futures price, and here's the expiry, what we would see is something like this. Pretty much a straight line. Might be a little bit of wobbling in that line, depending, because a lot of this depends upon interest rates, right? Because I'm borrowing money ahead of time. And so as interest rates vary, I'm going to get a little bit of wobble in that, but it's going to be pretty close to a straight line. So does that get close to the answer to your question?
Yes, thank you.
Okay. Yeah, there's I actually teach, we haven't offered the class, or at least I should say I haven't taught it recently, but we do a class on derivatives, so futures and options and swaps in great detail. And this is one of the relations that we look at in particular. It's kind of a fun area to dig a little bit deeper into. But thank you for that. Yeah, I enjoy that class. I missed not teaching it. All right, so let's we still got a couple of minutes here, so let me just give you the quick and dirty version of options so that you can kind of, because options are one of the more unintuitive things that we do in finance, but they're not unintelligible at all once you get used to it. We've got two types of options: a call option and a put option. There are always two parties to each option, and we don't have to have a call to have a put, and vice versa. But we do have to have a buyer and a seller of each of those types of options. And the call option, again, remember, these things are just contracts. The call option is a contract that says, if you buy this contract, you have the right, but not obligation, to buy the underlying thing. Now, in the futures contract, you've obligated yourself to buy that barrel of oil if you're the buyer. Now, you can still sell that obligation to somebody else, but in the difference between that and the options contract is you can hold the options contract till expiration and never sell it to anybody, but you don't have to actually buy that barrel of oil. And when would you not want to buy that barrel of oil? When the spot price of oil is below the price in the contract on the call option. So let's say the call option is to buy a barrel of oil at $70 a barrel in 1 year. Well, and you actually now you also have to pay the seller of that contract some amount of money. You might pay them $5 for that option. And 1 year passes. And then we look at the price of oil in the spot market, and the price of oil is $80. And you say, to the seller of the contract, I want to buy that oil for $70. So now you're in that oil for the $5 you paid up front plus $70 that you're paying right now, $75. But the value of that oil is $80. So you made $5. Suppose, though, that the price of oil had dropped down to $60. Then you just crinkle up the contract and you say, it's gone. I'm not buying. I lost $5. I lost $5, but I didn't have to buy the oil at 60. Or excuse me, I didn't have to buy it at 70 when it's only worth 60. I still lost $5 because that was what I paid for it. That's non-refundable. But I didn't have to pay 70 for it. So that's the difference between an option and a futures contract. Now, the call option gives you the right but not obligation to buy that underlying barrel of oil. The put option would give you the right to sell that barrel of oil to the counterparty of the contract. That's the one that gets a little confusing because, wait a minute, I'm the buyer of the contract, but that gives me the right to sell the underlying to the seller of the contract. And the answer is yes, that's correct. So a put option, if you buy it, gives you the right to sell that thing. A call option, if you buy the contract, it gives you the right to buy that thing. Now, let's look at it from the seller's side, the contract seller's side. By the way, we also call that seller the writer of the contract because they literally write the contract out. The seller doesn't get a choice. They get what's called the premium. That is that non-refundable upfront payment for the contract. I mean, if they didn't get it, they would be obligating themselves to a situation where they might lose money for no money up front. That's not even a legal contract, right? So you got to pay something. So the seller just has to do whatever the buyer wants to do. So if it's a call option and the buyer wants to buy the underlying at the contract price, they've got to sell it at the contract price. If it's a put option and the buyer wants to sell the thing at the contract price, or what's also called the exercise price, then they have to buy that thing from the contract buyer, the contract owner. So that's the difference between a put and a call. And let's see, categories. Let's not get into that yet. It's already 9:13. So that gives you a little preview of options. I'm only probably going to spend about 30 minutes on Tuesday to wrap up the options piece of it. We could go into all kinds of depth on that, but because it's just part of chapter 3 and we really need to get into chapter 6 on Tuesday as well, I want to spend some time doing that. So any other questions? Okay, just a reminder, don't forget 2 due dates between now and the next class period. July 10th is the due date for reading and doing the Learn Smart on chapters 1, 2, and 3. And then July 12th is the deadline for reading and doing the Learn Smart on chapter 6 and doing the homework for chapters 1 and 2. I know it's a lot of work, but it's not that hard a material to understand, so hopefully it won't take a ton of time to get that done. But that kind of gets us caught up. And then from there on out, the due dates are always going to be Monday night and Wednesday night. All right? Have a great weekend, and I will see you all on Tuesday. Thank you.